Picture this. You invest your first $1,000. You check your portfolio every morning like it's your newborn baby. 6 months later, you're down 30% and considering a career change. Sound familiar? You're not alone. Most beginners think investing is like planting a money tree. Water it with cash, wait a few months, harvest millions. Reality hits harder than a sledgehammer to the face. Here's the brutal truth. It's not the stocks that kill your portfolio. It's the mistakes you make along the way. 7 deadly sins that turn promising investors into cautionary tales. Let's fix that. Mistake number 1. Playing fortune teller with your money. Timing the market is like trying to catch lightning in a bottle while blindfolded. During a thunderstorm, on a unicycle, Sarah thought she was smart. She watched the market drop and decided to wait for the perfect entry point. The market kept dropping. She kept waiting. Then it shot up 40% in 2 weeks while she was still waiting for that perfect moment. Here's what the math tells us. Invest $10,000 in the S&P 500 in 1995 and forget about it? You'd have over $200,000 today. Miss just the 10 best trading days in those 30 years? You'd have half that amount, 10 days, out of over 7,000 trading days. That's like missing 10 minutes of a 12-hour flight and ending up in the wrong country. The secret isn't timing the market, it's time in the market. Your money needs time to work its magic. Mistake number 2, becoming a financial chicken little. The sky is falling. Your portfolio drops 20% and your brain screams, sell everything. March 2020, COVID hits. Markets crater 30% in 3 weeks. Headlines scream global economic collapse. Beginners panic sell everything, convinced they're saving their financial lives. Plot twist. Those who held on doubled their money in 18 months. Think of market crashes like earthquakes. Terrifying while they're happening. But when the shaking stops, the ground is still there. Your investments don't disappear during volatility. They just go on sale. Tom learned this the expensive way. He sold everything during the 2020 crash, then watched from the sidelines as the market reached new heights. His safe move cost him $60,000 in gains. Paper losses only become real losses when you hit the sell button. Every market crash in history has been followed by recovery, every single one. Mistake number 3, chasing shiny objects like a financial magpie. GameStop to the moon, Dogecoin millionaire by Thursday, AMC rocket ship emoji. Sound like your investment strategy? You're not investing. You're gambling with extra steps. Remember the dot-com bubble? Companies added .com to their names, and stock prices jumped 70% overnight. Pets.com sold dog food online and was worth more than Walmart. Spoiler alert, it wasn't. Most of these companies crashed to zero faster than a lead balloon. By the time everyone's talking about a stock, the party's over. You're not fashionably late. You're showing up to clean the dishes. Lisa heard about Bitcoin when it hit $60,000. She mortgaged her house to buy more. Bitcoin promptly dropped to $20,000. Lisa's now renting an apartment and working weekends. Chasing hot stocks is like chasing ambulances. You might catch one, but it's never going anywhere good. Mistake number 4, putting all your eggs in one very expensive basket. Meet Dave, tech genius. Invested his entire life savings in his company's stock. Made sense, right? He knew the business inside and out. The company was Enron. Dave lost everything. His job, his savings, his retirement, all gone because he bet everything on one horse. Diversification isn't complicated. It's insurance for your money. When tech crashes, healthcare might soar. When energy tanks, consumer goods stay steady. Index funds give you instant diversification. One purchase, 500 companies. That's like buying a slice of the entire American economy instead of betting on one company. Mistake number 5. Death by 1,000 fees. Fees are like termites. You don't notice them at first, but they're eating your house from the inside. 2 investors start with $100,000. Investor A pays 2% annual fees. Investor B pays 0.05%. Same returns otherwise. 30 years later, Investor A has $600,000. Investor B has over $1 million. Same money, same time, different fees. That small 2% fee cost $400,000. That's a house, or your kid's college education, or early retirement. John Bogle built Vanguard on this simple truth. Fees compound against you. Every dollar in fees is a dollar not growing in your account. Mistake number 6. Investing like a drunk person. Shopping. No plan, no goals, just throwing money at random stuff and hoping it works out. Meet Jessica. She owns Tesla, Apple, Bitcoin, gold, some random crypto, and 3 different sector ETFs. She checks her portfolio 10 times a day and panics when anything moves. Why? Because she has no idea what she's trying to accomplish. Now meet Mike. His goal, retire in 30 years with $2 million. His strategy, 80% stock index funds, 20% bonds. He checks his portfolio once a month and sleeps like a baby. Same market, different outcomes. The difference, Mike has a plan. Jessica has chaos. Without a goal, every market move feels like a crisis. With a clear target, daily volatility becomes background noise. Mistake number 7. Expecting money to grow. Like Jack's beanstalk. Get-rich-quick schemes are like unicorns. Everyone talks about them. Nobody's actually seen one. Amazon stock lost 90% of its value between 2000 and 2002. Most investors sold, convinced it was game over. Those who held on? That original investment is now worth 60 times more. Warren Buffett nailed it. The stock market is a device for transferring money from the impatient to the patient. Building wealth isn't about finding the next GameStop. It's about buying quality investments and giving them time to compound. Boring beats flashy every time. Real wealth builds like stalactites. Drop by drop, year by year, until you look up one day and realize you're rich. The fastest way to get rich slowly? Start today. Invest regularly. Stay diversified. Keep fees low. Ignore the noise. Give time. Your future self will thank you. And that's it for today's video. I hope you found this video helpful. If you did, please consider subscribing and liking this video to continue growing this community. Thanks for watching, and I'll see you very soon. Bye.